following the telecom space lately, CelcomDigi's latest quarterly results, well, they look pretty boring on the surface. We're talking a completely flat top line. But beneath those seemingly sleepy numbers, there's actually a thrilling turnaround story happening right now. So let's peel back the layers and uncover exactly what the broader market is missing. The disconnect here is honestly staggering. The market saw revenue flatline at RM 3.21 billion and basically just yawned. I mean, most retail investors, they glance at that flat top line, assume it's just stagnation in a completely saturated market, and move right along. But in high-level financial analysis, the headline is almost never the whole story. Check this out, because despite that perfectly flat revenue, net profit quietly surged by 8.85% to a massive RM $418 million. So how exactly does a telecom giant grow its bottom line by nearly 9% when its top line literally hasn't moved an inch? Well, that is exactly the mystery we are solving today. Okay, let's quickly run through our roadmap for today. First, we'll look at the flat revenue illusion, then unlocking hidden profit margins, choosing quality over quantity, the free cash flow machine, some hidden risks to watch, and finally, the final verdict. Section 1. The flat revenue illusion, decoding the headline numbers. Let's start with the surface-level data that initially put the market to sleep, and why they were definitely wrong to look away. While top-line revenue looks completely flat, here is the absolutely crucial point. Earnings before interest and taxes actually grew nearly 5 times faster than revenue. And guys, that is the classic hallmark of a company in serious margin expansion mode. Sure, revenue growth is great, but operational efficiency, that's the real thesis here. The bottom of their income statement is expanding way faster than the top. Section 2. Unlocking hidden profit margins, rebuilding the cost structure. Let's follow our next clue and see how they are structurally repricing their entire business from the inside out.
If we dig directly into the raw financial filings, the real story starts to emerge. Total costs declined by RM $250 million compared to the preceding quarter. Why? Well, largely because those super noisy one-off integration costs from the merger are finally gone. For the last few years, their financials have been seriously dragged down by the sheer expense of smashing together 2 massive network stacks, 2 IT systems, and 2 huge workforces. Well, that noise is officially clearing out.
Under their operational excellence initiatives, they just delivered RM $140 million in combined savings in a single quarter. And this is a structural repricing, not just some one-time accounting trick. They pulled roughly RM $40 million in net savings from cost of goods sold and operating expenses, right alongside close to RM $100 million in capital expenditure savings just through smarter sourcing and procurement. If you annualize that performance, you aren't just looking at spare change. That is over ₹500 million in newly unlocked value. Now, if these steady-state savings actually materialize, you're looking at a potential doubling of earnings power from cost-cutting alone. 0 revenue growth required. Think about that for a second. Management's 5-year synergy target remains totally intact. They are currently pulling in around $1.5 billion in annual net profit. Stripping out $700 to $800 million in costs by 2028, that fundamentally transforms the profitability of this entire company. Section 3. Choosing quality over quantity, the subscriber shift. So you might be wondering, why is revenue completely flat if profits are rising so much? It all comes down to who they are actually selling to. Basically, management is deliberately killing off low-quality, one-time prepaid SIM acquisitions to focus on high-margin, sticky monthly memberships. They are choosing margin over vanity metrics, and it's brilliant. Think of the prepaid market like a fast food drive-thru. A customer buys a SIM, tops up 10 ringgit, and might just churn the very next month for a competitor's discount. It artificially inflates subscriber counts, sure, but it destroys average revenue per user, or RPU. Postpaid and fiber customers, on the other hand, those are essentially contracted monthly memberships. And the proof is right here in the fiber segment, which completely exploded with a 47.8% year-on-year growth. Now, 337,000 subscribers might seem kind of small compared to their giant mobile base, but this is the holy grail of telecom, deeply sticky revenue. Once a household takes the time to install fiber, churn drops to near 0. The lifetime value of these customers is just astronomically higher. Section 4. The free cash flow machine, the merger payoff. Now we reach the big reveal. Let's look at how these efficiencies turn CelcomDigi into a structural cash flow machine. First up, the heavy lifting is finally over. Capital expenditure just dropped by 20.9% to RM $117 million, simply because the super expensive merger integration is concluding.
Going forward, they expect this capital intensity to stay really lean, sitting at just 12 to 13% of total revenue.
Second, their operating cash flow is an absolute fortress, hitting a massive RM$867 million in the first quarter alone. It's simple math. When you subtract a rapidly shrinking capex from a highly robust operating cash flow, you get exponential growth in free cash flow.
Third, and this is the kicker, they maintain a concrete commitment to distribute a minimum of 80% of net earnings right back to shareholders. Free cash flows is the actual, hard cash left over to pay you, the investor. This pivot from a capital-heavy integration phase to a lean, cash-generative machine makes CelcomDigi a dividend compounder you honestly cannot ignore.
Section 5. Hidden Risks to Watch. The Impartial Reality Check. Okay, but to remain completely objective here, we must abruptly hit the brakes and look at the lurking dangers buried in the numbers. No financial deep dive is complete without a hard look at the downside. Here is the elephant in the room. A massive $14.3 billion in loans and borrowings sits on their balance sheet. That means finance costs, which are already sitting at $155 million this quarter, won't shrink easily if interest rates remain high. Their net debt position is rising, and carrying $14.3 billion in leverage in a higher-for-longer interest rate environment is a major risk that investors absolutely must monitor. On top of that, we need to keep a close eye on the upcoming DNB 5G loss sharing kicking off in the second half of the year, an unexplained 57% spike in maintenance costs and a doubling of credit losses. Digital National Berhad, or DNB, is still burning cash as it builds out Malaysia's 5G network. CelcomDigi has to absorb its share of those losses starting in the second half of 2026, and that's going to put an ugly, albeit expected, dent in the headline profits. Plus, that elevated allowance for credit losses definitely suggests some potential deterioration in receivables quality that we just can't gloss over. Section 6. The Final Verdict. Navigating the Re-rating Timeline. Okay, let's bring this all together and see what it actually means for long-term investors. The telco is very clearly moving from the messy chaos and cost phase straight into completion and clarity. And this is the exact moment when analyst models can finally be built with real confidence. Re-ratings usually happen with a 12 to 24-month lag as the broader market slowly wakes up to the fact that all those integration headwinds have officially transformed into massive margin-expanding tailwinds. The catalyst checklist for a structural re-rating is filling up incredibly fast, proving that the underlying fundamentals are vastly stronger than that flat headline revenue suggests. And especially look at that last point. Securing 15 years of spectrum certainty through the recent DNB shareholding agreement essentially hands them a government-backed competitive moat. That's huge. We'll leave you with this final thought to ponder. With a collapsing cost base, surging free cash flow, and an 80% dividend commitment, how much longer can the market actually treat CelcomDigi like it's a stagnant company still stuck in integration mode? Keep looking past those headline numbers, folks, because when you do, a seemingly boring flatline often reveals a brilliant operational masterclass. Thanks for joining this explainer, and stay curious.